Our speaker today, as we all know, is Mr. Ricardo Roncco. He's head of technical analysis of VAT Global in London. Please excuse me as I'm print on this is very, very small. Mr. Roncco follows large and mid-cap European and US equities, paying attention to domestic and foreign equity indices, currencies, commodities, and interest rates.
Everything.
Ricardo is a medium trend follower. His approach is strongly quantitative in nature. Particular attention, however, is devoted to identifying reversal patterns characterized by excessive consensus among investors. Ricardo brings more than 15 years of experience in trading, quantitative analysis, and teaching technical analysis in the UK and Italy. Prior to joining VAT Global in April 2010, Mr. Roncco worked for Crédit Agricole, Banca Intesa Group, and FBR Capital Markets. He's a frequent guest on CNBC Europe and other European media outlets, a member of the MPA, and he was also a speaker at the International Federation of Technical Analysts conference in Rome in 1998, and in Beijing in 2011, recently at the 2015 symposium in New York. His work is mentioned in the book Capital Market Revolution, The Future of Markets in an Online World by Patrick Young. Mr. Roncco received his degree with honors in economics from the University of Turin. He currently holds the CMD level 1 and 2 diplomas. His presentation will be on trend following application to equities. And without further ado, thank you.
I should short the introduction. The biography seems to be a bit too long. We have 1 hour, if I reckon. As usual, it's going to be very much packed with a lot of stuff. It's not going to be, there are going to be 3 concepts here we're going to discuss. We're going to discuss the nature of trends. We're going to discuss their optimization related to trend following. And the last point is how to use filters to make trend following applied to equities a little bit less painful compared with what we see in general. So it's usually, there are all the disclaimer. What about the disclaimer? I'm not going to read all this. You read this one? Yeah. Okay. This is very interesting. It's usually you have to start to break the ice with a bit of a joke, something funny. Or you see all that heavy stuff coming later. And this is a picture of youngsters using computers, all from Apple, and the Apple motto is "Think Different." So everyone, there is a bit of irony here, because as a trend follower, you have to basically behave. Follow the herd instinct, so if everyone, if the trend is on the upside, you have to join it. But there is also the point that eventually you have to get out of this kind of trend. So I like this thing because there is a bit of a contrast between what you can achieve with an idea and the end result. Now, the idea of trend following, I did a presentation similar to this one. This one is a kind of evolution, and the idea is why trend follower. Trend following is being exploited for it has a long history. The best starting point for me, if you're interested, there is this paper from Hart, Hoy, and Peterson. This presentation is available for everyone. If the MPA can make it available by email, there is the email address at the bottom. So if you want it, you can ask me, and I will gladly send it to you by email. So the best starting point is this paper, Demystifying Managed Futures by Hart, Hoy, and Peterson. And it's about futures, but they also try to explain the reason trend following is effective in the markets. And here I put a chart of Amgen. It's not particularly interesting, the name of the stock. And you see the classic pattern of trend corrections. The red line represents the fundamental value. It's just a figment of imagination. What is important is to see the reaction between prices and the alleged fundamental value. So let's say that the value of, from a fundamental point of view, of Amgen is around $115. Then there is a shock, a fundamental shock. It could be good earnings, something happens to the market, and the fundamental value of Amgen jumps up to $155. Well, the stock is not immediately adjusting to this information. What Peterson and his colleagues are discussing is there are several behavioral biases in investors' mentality that are slowing down the adjustment of the price of the stock to its fundamental value. This anchoring and the disposition effect, basically selling the winners and holding on to the losers because of good effect. And this is slowing down initially the price. This is allowing trend following model to kick in. They give the time to jump into a position following the trend. And then you have the second phase when the trend is actually developing nicely. You have the herd instinct coming in, performance chasing models, performance chasing fundamental analysts and portfolio managers that chase performance because otherwise they lose their jobs. And there is the final part of the trend, there is the overreaction, and that's when the stock goes way beyond the fundamental value. There are now fundamental investors kicking in, starting to sell, and then the stock goes back to allegedly its fundamental value. This allows any trend following model to enter on a breakout, hold onto the trend, and then when the conditions are no longer present in the trend, to get out. So the importance of the paper is to give you all the psychological and prospect theory reasons why we should use trend following in our work. Trend following, as I said before, it has a long history. No relations with Mr. David Ricardo. The surname is The Economist. He's been using, apparently, in 1772, 1823, he was using trend following in his work. And there is a book, The Great Metropolis, 1838. And if you look at what he's saying, the author James Grant is quoting the ideas of David Ricardo, and he says, let your profit run on, cutting short one's losses, and this is the same that we see now by Mr. Lindsay Cotter. So it's nothing new under the sun. The principle, the basic principle of trend following are there. The problem, we are going to see that is interesting to see the evolution that we have nowadays. That we all know that there are positive and negative feedbacks in the market. So positive feedback, the stock is going higher, is attracting more buying, and investors are jumping to the kind of stock. At the same time, they sell what is lagging, and they create a kind of divergence in the behavior of prices. The stocks that become strong, that are strong, become stronger. The stocks that are weak, they become weaker. And that's basically the positive feedback. Negative feedback instead is the stock goes down, people see it as a buying opportunity, buy on dips, or a stock is rallying, sell on rally, and that kind of, these two forces have their own trends. We are going to see that. They have their own trends. They are not things that are lasting 1 minute or 1 hour or one week. They can last a little bit longer. And the interesting thing is that we have this shift between positive feedback and negative feedback. So inside we can have a bullish trend or a bearish trend, and we can have a strong trend to the upside or a weaker trend to the downside, but then we have to add another kind of color. It's the kind of quality of the trend. So the idea is to monitor how investors are rotating out of a concept of I want to buy the winners, I want to chase the losers. And in technical analysis, we have two simple tools. The first one is the relative strength, the ratio between a stock and the index. I apologize, these concepts are for some of you already well known, but I have to assume that there are many people new here, and I have to introduce this concept for the first time. So bear with me, we are going to get to the meat a little bit later. So relative strength is a ratio between the price of a stock against the price of an index. And if we want to use it to find the leaders, we want to see the ratio going higher. If we want to short a laggard, we want to see a stock that is underperforming the market. Okay? Another way to identify leaders and laggards is by using ranking. I've personally been using ranking on a 6-month basis in the last 15 years, but the studies that are more interesting are between 6 and 12 months. And again, if you're interested on the why momentum is an important factor besides trend following, the paper that you have to consider is this Value and Momentum Everywhere, again by Peterson and other two associates. So this is a classic example. Because something that goes up has to be compared with something else. This is the S&P 500 energy sector. We can see from 2003 up to 2008, we are in an uptrend, objectively, and the energy sector is outperforming the S&P 500. So technical analysis in this case says, I like the trend and the sector is outperforming. I want to overweight this kind of area. I want to buy the stocks that belong to this area. Now let's look at 2011 against 2014. Again, from an objective point of view, the energy sector is going higher, but is underperforming the S&P 500. I don't want to be in this sector because there are other sectors that are doing better. Now this is a very simple concept. I prefer the weekly charts, monthly charts to identify this kind of ideas. It works. It's a very simple concept, relative strength. You can apply the same tools that you apply on a price time series on relative strength as well and create interesting maps. Also, it works to the downside. Let's say from 2001 and 2003, energy stocks go down, but the relative strength is going higher. This means that investors are not actually dumping energy stocks to the rest of the market. So this is an indication of possible future leadership. If you create a quadrant of 2 by 2, you can identify price up or down, relative strength up or down. You have 4 situations, and you can pinpoint exactly which sector or stocks is where and see the dynamic of the kind of stock. And that's a very powerful information. Then another situation is this, the stock market here, let's say from 2014 until now, energy stocks are going down and they are badly lagging the market. You want to short this area. You don't want to own it. Not only you don't want to own it, you want to short it. So just the fact that trend is up, you have to compare it with other things. So on a daily basis, your job would be to buy, ideally, bullish breakouts in stocks that are going up in a trend that belongs to sectors and countries that are beating other countries. On the same token, you want to short stocks that are breaking down in downtrend that belongs to crappy sectors in countries that are underperforming the MSCI World Index. If that was so simple, it would be great. Unfortunately, this is not the case. Because unfortunately, the trend following changes its nature. It's a kind of factor like value. Value seems to work. Market cap, small caps sometimes seems to work very well compared with large caps. Value seems better than growth. And trend following momentum is a factor. So there are moments when they say, oh, trend following is dead. No, it's a factor. It's changing a bit its nature. The important question we have to ask is, this kind of trend following momentum, which kind of environment we are? Is a momentum of, we are in an environment of high momentum or low momentum where we have mean reversions? What we had discussed before, like, are we in a positive feedback environment where stocks that are strong get stronger and weak stocks are becoming weaker? Or we are instead in a negative feedback? We have to ask this question. Why? Because there is something nasty called momentum crashes. And again, another paper that I suggest you read is very good. By Daniel and Moskowitz. It's a recent paper. Basically what they discovered, that when they go back, I will show you the charts on the way. Basically what they do, they go back 1940 until 2006. Every month, they take all the stocks of the New York Stock Exchange, Amex, and Nasdaq. Every month, they rank on a 12-month basis. Okay? They make a nice list, and they divide by the side. They take the top 10% is the winners, and the bottom 10% are the losers. And they build 2 portfolios. And every month, they redo the exercise. The result is this one, in this chart. You start with, let's say, $1, and this is a logarithmic chart, and you go back here, 2006. And constantly being long a portfolio of winners give you $54,000, starting from $1 in the last 60 years. If you buy the bottom decile, so the stocks that in 1 year done the worst, the dogs, and you consistently do that, you're always long the worst, you actually lose money, 0.04. The spread between these 2 strategies is 16% compounded per year. But it's not an easy strategy because when we plot the spread between these two, there are the momentum crashes. It's something that I noticed, for example, in 2000, I was doing an exercise for a trend following colleague in a UK bank. And I was using sectors on the S&P 500. I was trying to find, I didn't have the ability to do all stocks at the time. So to do a back test, I had to use the sectors. And the idea is that unfortunately, in certain situations, the persistency of strong trends stops and it crashes badly. And that happens after huge trends in one direction, and then you have a bear market, and the bear market completely crashes that kind of information. And unfortunately, this kind of factor is not 1 day, 1 week. It can last for months, and sometimes it can last for years. So we have to, being a trend follower, just say, I just buy bullish breakouts. Well, someone did that, and it was Mr. Jesse Livermore. This is the Dow Jones between 1903 and 1914. He was a trend follower. He was just buying highs and holding. Okay, maybe his money management was not up to scratch of what he had now, but that was his philosophy. And in his books that I strongly suggest to read and reread again, it says, those were the lean years, 1911, 1914, the market flattened out, and this is the part you see in the little square. Things drifted from bad to worse. I not only lost all I had, I got into debt again. There was no money to be made. And so a trend follower can enter a situation of a market that is extremely adverse. Even if the approach per se is extremely sound, long term, it can crash you if you don't know in which kind of environment you are. Are you in a positive feedback environment? Are you in a negative feedback environment? So going back to the point.
Are you planning to give these slides?
Sorry?
Are you planning to provide these slides to the audience?
Yes, everyone, I'll send as I say, you can have the presentation by mail. I will send it tomorrow, no problem. Now, the momentum crashes happens in this situation. You have the end of a bear market, and it's a very dramatic event. Investors are liquidating all their stocks. And then there is a huge rally. So you will be tempted to say, okay, I'm a trend follower, I'm going to buy the best of the best. Okay? I've been doing that, it was working before, it should work nicely. In 1942, in just 2 months, the market rallies 80%. The winners, they just go up 30%. So the one that they've done better in the last 12 months, that you would like to continue to buy, they just go up 30%. That is less than half of the market. The stocks that were awful, they were dumped until the last day, are the ones that are bought on the Dow. And they outperformed 236%. Okay? Recently, March 2009, we see the S&P 500 is bottoming at 666, and we have a violent rally in March and May of 40%. The difference between owning the right kind of stock and between the wrong and the right kind of stocks is astonishing, because the past losers go up 156% against the market going up 40%. 4 times. You're left behind. You're doing the right thing. You're buying the quality. You're buying your model. You're buying the best stocks. And yet, in a momentum crash, you're lagging the market. In this kind of condition, it's better you just buy the market. Don't try to chase what was the best stock before. It doesn't work. The jump is what is working. And we can see it here again. In the 30s, that's the beginning of the 30s, the red line represents the past losers. And the green line represents the market. The blue line instead represents the winner. For 6 years, chasing the winners, the past winners, is doing worse than the market. You're okay, P&L, but the market is going much better than you can do with this kind of method. The past losers are really making a killing. But you can see also the dynamic is not constant. The dynamic of outperformance of winners and losers is changing with the passing of time. The same thing, if you look back at something more recent, in 2009. In 2009, I normalized all the indices at 0. What I'm using here are 2 time series, the Dow Jones thematic momentum index. You can find them at the bottom. I left the link for you. Basically, you take the Russell 1000 stocks, you rank again by 12 months, and you take the top 20%, is the winners, you take the bottom 20%, these are the losers, okay? And you build two equity lines, like two portfolio managers. They just do one thing, like robots. One continues to buy the best of the best, and the other guy buys the worst of the worst. And the two equity lines are, the green one represents the S&P 500 total return, and the red line represents instead the losers. And as you can see, the market in a couple of years, from 2009 to 2011, goes up 100% total return. Great. So you pretty much do the same if you buy the winners. But if you buy what was dumped until, let's say, February 2009, you do 250%. That's what is a momentum crash. If you follow the momentum, you don't perform as the market. And now, it is something that we see at the beginning of every bull market. The beginning of a bull market is always characterized by a huge jump of what I call the junk rally. The stocks that were dumped before are bought. Now, the reasons they are bought are multiple. Taking a punt, stupid valuations. So investors, they say, well, that's the moment. They put the finger there, they catch the falling knife finally. After, you have 5 fingers in one hand, how many falling knives you can take? And losing your fingers. Eventually someone can do it. So you can see the performance of these leaders and laggards is changing in time. So what can we do about it? Because it's important. As I said, if you just try to buy bullish breakouts in a bull market and sell bearish breakdown in a bear market without knowing the environment you're in, you can do what happened to Jesse Livermore. So the idea is pretty much simple. We use, again, technical analysis, we use a relative strength, we plot the ratio between the Dow Jones winners, high momentum, time series, against the Dow Jones low momentum, that are the losers. The relative strength is telling us which kind of these two portfolio managers, the one that buys the best of the best and the guy that buys the worst of the worst, is outperforming. So we know if we are in a trend following environment or in a mean reversion environment. We know if you are in a positive feedback environment or in a negative feedback environment. And believe me, this makes the difference, because sometimes you see the market going higher, but if you are in the wrong kind of stocks, meaning you're in the wrong kind of environment, and you continue to do the same thing that it was working until before, you are left behind. Again, it can be in a dramatic way when there is the beginning of a bull market, or it can be something more subtle. The market goes up 10%, you go up 8%. You've done the right thing, but you're still lagging behind. So, this is the interesting thing. This is the S&P 500 equal weight daily charts going back to October 11, so the last 4 years. Do we agree that this is the market going higher, right? It's good. Higher highs, higher lows, pullbacks, no problem. This is the 50 and the 200-day moving average. Below is the ratio. In the blue line represents the ratio between high momentum against low momentum. So we have the ratio between two portfolios, the guy that buys the best and the guys that buys the worst. And the ratio when it goes higher means that you want to buy breakouts and sell breakdowns. When the ratio goes down, you want to be a buy on dips guy and sell on rallies to take profit. If you are in an uptrend, you want to respect that. But if you try to buy on dips when there is a trend following environment, you are going to lag the market and vice versa. In an environment where you have a mean reversion, like you see the trend line here, this is a mean reversion situation because the stock, this is the relative performance of high against low momentum is going down. This means that stocks that are with low momentum are outperforming stocks with high momentum. This means you want to buy on dips in an uptrend. Okay? And in an uptrend like this one on the S&P 500, you have an alternation of phases. You have trend following, mean reversion, trend following, mean reversion. When I say trend following, I mean buy breakouts and sell breakdowns. And so we can say, in a way, that certainly if there is a momentum, there is a trend. But if there is a trend, not necessarily the driving force is momentum. It can be mean reversion. And we have to be aware and adjust our strategy. Or if we are just trend followers, pure and simple, we should have to have a system like this to tell us, let's stop buying breakouts and selling breakdowns, because we are in an environment that is going to kill us. It's going to kill our portfolio. So these kind of time series are, I think, available on internet. You can download them. Here we can see again the pattern. For example, in the bear market of 2007, 2009, the market goes down and then there is this huge rally. The beginning of a bear market, I'm not trying to think this is a philosophy, Ricardo's philosophy, how the nature of bull and bears would be nice, but I don't think, I'm not the first one to do this kind of stuff. I can show you this. The idea is, at the end of a bull market, the fear of missing out is pushing investors to buy the stocks that have not been performing, right? Stocks that have done very, very well, their valuations are very expensive. So they are not going to be chased. They are going to chase investors what has been left behind. Now, the external events trigger a bear market. All these investors, the weak hands, those with the fear of missing out, that bought the lagging stocks, are going to see losses, because those stocks were lagging for a reason, fundamental reason. And they start to break down. And they are forced to liquidate. On the breakdown, they continue to see negative P&L. Eventually, they have to throw in the towel. Okay? And this ratio, going higher, is telling you that investors are buying breakouts, or in this case, they are selling breakdowns. So the beginning of the bear market is always associated with the liquidation of the weak hands. And the interesting thing is this, a bear market is always what I call a trend following affair on the way down. When it bounces, it's a mean reversion. It's the buy on dips. And you can see every swing to the downside, directional swing in the market is associated with an acceleration of liquidation of losers, until this liquidation of losers reaches a level of stupidity from a fundamental point of view, where the smart money jumps in and starts to buy. The beginning of a bull market is always a junk rally. What was thrown away yesterday jumps back up. You remember the banks in 2009. They were, in February, no one wanted to touch them. April, they continued to go. And the thing is, because it took months, if not a couple of years, to have disgust for banking stocks, when they start to move higher, no one wants to touch them. So they outperform because liquidity gaps, nobody wants to sell them, and the liquidity and the spreads are very wide. So the beginning of a bull market is always a junk rally. And the interesting thing is, up to a point where the situation comes down, central banks are intervening, the economy is becoming more stable, visibility for investors is much clearer, so we can go back to an environment that is trend following. So if there are positive earnings, the stock is breaking higher. If there are negative earnings, the stock is breaking down. Same thing, this is 2003. Look, between 2002 and 2003, the market goes down and is a trend following affair to the downside. Then you have a rally, that is a mean reversion, a new attack of liquidation, and this again, weak hands that are selling at the last second thinking, oh my God, it's the end of the world. And then you have the junk rally, and you can see the market going higher, but not on the strongest stocks, on the stocks that were sold until the month before. Then you have another situation of stability, and then trend following works again. So there is this kind of a bull market, just because it's trending higher, is not necessarily driven by breakouts. There is a rotation in mentality. A bear market, instead, is trend following to the downside, and the pullback is a reversion. And we have to know this when we pick the stocks. Or if you want to give a better color to our investors, we can use this kind of simple technology. Now, thank you very much, Ricardo. I cannot access your Dow Jones thematic indices. What can I do? Well, as an alternative, my suggestion is to use an ETF called MTUM. It's using only the top 10% of the winners, long only. And as a proxy, as an alternative to the kind of study that I showed you before, you can plot MTUM as an ETF against SPY. And the ratio is going to tell you, do you want to buy breakouts and sell breakdowns, or you want to be a buy on dips, sell on rallies guy? So you need a definition of the trend of the market, and you need to give a color. Which kind of market is this? Is it a trend following high momentum, or it's a mean reversion, buy on dips, sell on rallies? So we can tailor. The man that has only a hammer in his hand sees the world made of nails. And you become like Clarkson in Top Gear. He's always using a hammer on everything when he has to fix something. But if you have different tools for different situations, we can be a bit smarter. We can just do the trend following exercise and go through the pain of the momentum crashes. There is nothing wrong with that. But you have to be aware that there are moments where trend following doesn't work, and it can be years. If you are a CTA and you look at the classic performance of trend following of the last 3-4 years, everyone says trend following is dead. And then you have this big rally after 3-4 years of lean years of performance. Then everything is great again. Now, this is not only, I showed the US markets, it's the same thing for European equities. There are MSCI high-low momentum indices, and you can plot them against the Dow Jones Stock 600. Again, you can have a situation where the beginning of a bull market in 2009 and in 2003 is characterized by giant rallies. And then you can have an idea of, is this a bounce or the beginning of something more serious? And this for me is something very important. Every day, every week and every month, we try to qualify, is this an uptrend, is this a downtrend, is this something that I should say to the client, should I buy the breakout or should I buy the pullback? That's what it's all about, because that's the classic question. You see the breakout, should I fade it or should I go through it? And it depends on the environment. And the environment is, there are trends in the mentality of the market. And this is something that can help a trend follower to survive the lean years that Mr. Livermore went through. And this is something very important. You can recreate this kind of study at home. You rank your portfolio, say the FTSE, Italian stock index, the DAX. Take the top 10% and the bottom 10%, look at the performance, you do it on Excel, and you plot these performances. And you have your two portfolio managers. Okay? This is very important because it's going to give you an edge compared with those that just buy breakouts or just using buy on dips. People that are always buy on dips, hoping that the market will bounce. It depends on the kind of environment. Okay? It's very important. So this is the first problem that we try to solve with trend following. The second problem is when you do any kind of test and you say, which kind of parameter should I use? Trend following works, but should I use, let's say in case of moving averages, should I use a 10-month moving average, 12-month moving average, 3 months moving average? Which kind of average is the right one? Because we like perfection. We want the right answer. When we go to school and we study a subject, then you are questioned. You don't say, oh, a bit of this and a bit of that. No, you have to give the right answer. The stock market, apparently, markets in general, they don't work in that way. For example, here I show the test on the S&P 500 from 1930 of 4 moving averages test. So we buy if the close is above 6 months, and or 8, or 10, or 12, and we go flat. So it's just long only. It's a simple trend following. If you get the book, the Ivy Portfolio of Mebane Faber, you can see the logic. The interesting thing is the choice of parameters. We should go for the 6, which is the best. That's the classic question. And you can see, for example, for a long period of time, the 6-month moving average, this is the equity line starting from 100 in the early 30s. The blue line represents the equity line of just using 6 months moving averages, long only, okay? What happens here is quite interesting. We are in the apologies. In the mid-90s, there is a change, a shift from a slow-moving average like a 6-month to a 10, 12-month moving average. And so you need a tool, almost what can help me to decide, oh, today I use the 6, in 1 year I know I'm going to do something different, and you need a tool. And I've been trying, there are sophisticated techniques, and my idea is much simpler. I trade them all. So you just put a score. You have, instead of say, you have 100 to invest on the S&P 500 ETF, you have 4 moving averages, and you check if the close is above one of these 4 moving averages, right? And so you know you can adjust your exposure. If the close is above all the 4 moving averages, you are 100% invested. If it is below all 4 of them, you're in cash. If only 2, it doesn't matter which, you are 50% invested. This is very simple, but that's the way to have a robust, and you don't give a damn anymore which kind of value a moving average is working. You don't care, you use them all. And at the bottom, I'm showing you the exposure from 0 to 100% on this market, the S&P 500. The red line represents the buy and hold, and the blue line represents the strategy. There are no commissions, no taxation here, but I'm not reinvesting. When you're in cash, I'm not buying IEF or TLT or SHY. I'm not reinvesting the proceeds. And here, yes, of course, you are lagging the buy and hold, because every time there is a correction, by the time the trend following model is getting back in against a strong bull market, you're going to lag. But you have to judge a trend following approach over a full cycle, the bull and the bear cycle. And when you have many of these, not 1 week, 1 month, when you have several of these cycles, the end result is a very powerful equity line. Now, in this case, I use 6, 8, 10, and 12-month moving averages. We can use something a little bit thinner, so we can use 10 moving averages. So every month, we compare the close of today against 10 moving averages from 3 to 12, okay? And we have a score that is going to tell you, Ricardo, you're going to be invested 100% or 0%. And every month, you adjust a little bit your exposure. You underperform slightly with the model we saw before, because there are more adjustments. But this model is much more robust than just using 4 moving averages. Okay? And again, it would be much better if when you're in cash, you can reinvest in something else. I will show you. This is a bit, it looks so great on my Excel, and here it looks a little bit choppy, but let's say the blue line is the S&P 500 total return, buy and hold in the last, since 1992 is 8.9% compounded, okay? The other lines represents from 3 to 12 months, the idea of buying the S&P 500 if you're above the moving average. If not, you buy IEF, that is the equivalent 10 years, okay? And you have different performances, 12% compounded for the 12 months, 9 months, 13%, 12.5, which is the best. Of course, we see now the short-term moving average is the one that is underperforming. But if you were in the 60s, possibly it would be the best one. So who knows? And say, I don't care, use them all. And when you use them all, you have 11.92. It's not the best, it's not the worst, it's the most robust. And here we are reinvesting the proceeds of the trend following model using bonds. And these are the equity lines that you obtain, all these ones. And the orange one in the middle is the average of this thing. Once a month, you have just to make 4 checks and adapt. This is a simple thing you can test on Excel. It has to be simple so you can go home or the office, not now, possibly tomorrow, and test it on your own. Imagine to do that on a basket of asset classes, okay? This is just the S&P 500. Imagine you do that on a basket of asset classes. You have a robust trend following, once a month, checking. I think it's a very simple approach. The third problem is the problem when we invest in equities with drawdowns. My starting point here is how can we reduce the problem in a bear market when you're in a using a trend following model and you're in a bear market, there are always stocks breaking higher and you're tempted to say, okay, these are still the leaders, I want to buy them. And there is this kind of conflict between these two approaches. Now, here I show a potential simple solution that is not mine. I saw it somewhere else. Nick Raj has wrote a beautiful book, An Holy Grail, and it's a very simple concept. Here we take the S&P 100 global total return, so we took the first top 100 equities, and we apply a simple 10-month moving average on the index. The result, starting from 100, is 230 in 17 years, okay? The red line is buy and hold. The blue line is just once a month, do I invest or not? Again, here we just keep the strategy without investing in our cash when we are flat. Okay? At the bottom you can see maximum drawdowns. The buy and hold is giving you to heart attack minus 50%. The trend following is more modest, 19-20%. Okay? On Bloomberg, you have a function called BT. It's not the best thing in the world, but it's just to test the idea. So you take the top 100 stocks, and each stock you compare it against the 10-month moving average. Okay? If it is above, you own it. If it is below, you don't want to own it. Okay? So you're going to have 100 signals to check once a month. What I want to show you is the kind of equity line curve that you obtain by doing this kind of process. And you start, in this case, from 10 million. We put $100,000 in each stock. And we get, in the end, for 12 plus 10, so it's kind of 22. It's very similar to what we saw before. But before we were trading the index, you can trade it with an ETF. This one, you can trade it stock by stock. And in the squares, I'm showing you what happens in a bear market. All the stocks are killed one by one. There is the potential stocks that goes on its own and try to go higher, and you want to buy it, you follow it, the computer is doing it. And you have these kind of little losses that are pain in the neck, okay? Usually between 25-30%. That's the impact that you can have on the portfolio. Now, we do the same on the FTSE 100. On the FTSE 100, take one of the stocks, one by one. We compare against the 10-month moving average, and we obtain this equity line. So we start from 10 million pounds, and we reach up to 35 plus 10, so 45 million pounds. And again, you can see when there is a bear market, you have this kind of, in the squares I show the behavior of the portfolio. Now, the simple concept that Nick Raj is showing, and is quite interesting, is this. When you have to buy a stock, you check not only that the stock is above the 10-month moving average, but that the stock market is above its own 10-month moving average. It doesn't matter on the way out. On the way out, you listen just to the stock, but on the way in, both the stock and the stock market have to be above their respective 10-month moving average. On the way out, the stock is just simply to close. Now, this is the simulation where basically we don't care about the market. The next one is when we consider the stock market. And the advantage not necessarily is in terms of performance, but risk adjusted is much better. Not only that, in the previous case, you have, for example here, a new equity high in 2004. Using this approach, you have a new equity line in the third quarter of 2003. Not only that, here I don't reinvest. When you're in cash, you don't buy yields, but otherwise the equity line will be much better. So as a way to improve the performance, when you have an idea in the stock market, on a single stock, listen to what the stock market is doing. Now, you don't like monthly, use weeklies. Instead of using one moving average, you use two moving averages. Let's say 10-30 week, and you do it on the market, and you do it on every single stock. When I was showing before 4, 6, 8, 10, 12 month moving averages, You don't want to wait 1 month to do that. You want a bit more action. Fine, then use a basket of double moving averages. 10 against 40, 5 against 30, 5 against 20, 10 against 30, whatever works. And you create a basket of these strategies. So you don't have to do any optimization. You cover pretty much all the bases. And you create a score for every stock and you compare it with the stock market. It's a simple way. This is a starting point. There is scope to make this thing more interesting, more complicated, but that's not the point. My point was to show you with simple concept to understand that the trend per se is your friend, but it's a friend that he can change his mind, and you have to take that in consideration. The problem of optimization is something that the very first day I put my fingers on a computer, I was able to optimize as being something that I really, you want to see an equity line that is beautiful. You have to give up on this kind of idea. What you want to have is a robust concept, a robust model. Because if you just go for the best possible equity line, you're deceiving yourself. Because that's a beautiful picture of the past. And it's so difficult to let it go. Trust me. But if you want a robust model and say, should I put my money into that? What do you want to have? Because deep inside, if you do an overfitting, you know you're being overfitting. And this thing is going to bite you in the neck eventually. This is a much simpler starting point. You can evolve on that. If you want to discuss ideas with me, I'm happy. The email address is there. And as I said, I packed a lot of stuff, but these are very important concepts. And if anything, all the detractors, trend following, if they were using this kind of mentality and look at these things in a different way, maybe they would be more supportive of the subject, even when they have to invest money. So with this, I think I'm finished. If there are Q&A, I think I've been left with 10 minutes. I'm very happy to answer questions. 10 minutes?
Yes, sure. Okay. Any questions from the audience? From Ricardo's?
It's very interesting study you've done there. Do you have a perspective on using either momentum or trend following on individual stocks versus, on a sector basis? So, instead of, choosing the top 10% stocks, you choose the trending sector. Is there alpha from individual stocks versus that approach, or?
So, my study initially was using sectors in the S&P 500, and I saw the momentum crashes. And then I started to do the work on the environment we are in. Now, if I understand your question is, let's say, can Ricardo use, for example, the energy sector and dive inside the energy sector and take the top energy stocks and the bottom energy stocks and work against the sector? Is that the question? Or is the question?
That, or it may be that 4 sectors are exhibiting strong trends, and it may be that, the strongest trends in the entire market exhibited in 10 stocks that are across those, versus, just taking an exposure in the 4 sectors that are moving the most. Which one, do you have a view on whether there's a long-term alpha in the individual stock approach versus the sectors?
Personally, I would rather go for single sector, so if you can trade a basket of ETFs, I would rank the top ETFs and have clear that they are still in uptrend. When you shift to a situation of mean reversion, of low momentum, rather than chasing the sector that has been beaten up the most, I would go benchmark buying SPY. It's much more practical. And also volatility adjusted, I think, is much easier to digest. Because you have to consider at the bottom of the bear, mentally everyone is a wreck. And the last thing the chief risk officer wants is to see the VAR going all over the shop. So if you buy the index, it's much more palatable trying to buy the other one. It's an alternative. I think you can, if you do the exercise inside a sector to try to buy the best of the best, you go back to a subset of what we have done before to try to go across the board and pick the best of the best. So you can get the odd rogue stocks. For example, there can be stocks, the telecom sector is absolutely rubbish. So if you, not now, as a concept, But if there is one stock, say Vodafone, is doing well, with one logic you would go for it. They say, I just want the best stocks regardless of the sector. And the other say, no, it's in a sector that doesn't work, you would cross Vodafone. You could have different results. My impression is better that you stick with the best sectors because you put the odds more in your favor. Of course, this could be the odd story, but how probable it is that is a good one, sustainable in the future. So I would say filter the sector, filter the market, filter the sector, filter the stock, and understand which kind of environment you're in. And I think that real alpha is in that kind of situation. I hope.
Have you looked into, in your research, into short-term horizons, more of like the day trading?
Good
And
question.
if you have, what would you consider
All this work,
from?
all this work is using 6 to 12 months. Okay? With age, I appreciate the fact that I want to see the big trends, the big money. Well, I know if you run a high-frequency trading shop, I think you say, Ricardo, I disagree with you. But I like to catch the big trends. You want to catch gold from 200 to 1900, okay, 1600, but you catch the big one. And the only way is to step away from the noise. And again, doing this kind of work, you know which kind of noise. So let's say if you're in a mean reversion environment, you can use a shorter term. But my work has been always between 6 and 12 months. And the idea in 2000 to start work ranking between 6 and 12, mostly 6 months, is because I try to catch a stock in a cycle on the yearly cycle. I don't use 3 months because there is the dividend effect. And 1 year, I don't use it like instead many papers are doing because it's too slow. And funnily enough, now they're coming out saying 6 months actually has been always the best one. So I've been, in a way, lucky on that one. But I've been trying to use, on a sector basis, different time length. And 6 months was the one that was covering best basis everywhere. So my suggestion is, I wouldn't go, okay, I'm working for a brokerage house, and the more you trade, the more commissions. But my idea is trade less, trade better. So shift to a longer term horizon, change the size. Instead of doing the big size, you do a smaller size. You pay less commission to the broker, if you can say that. But you trade better, you quality, then eventually you can have a bigger size, you survive as an investor, and the broker maybe is happier, has done his job, he's helping in this case. So I prefer to shift with passing of time, stay away even from the daily chart, and start to appreciate the beauty of the weekly, the monthly, because the real trends, the real money is there. You see the big picture much better there. But again, this is technical analysis 101 that sometimes we forget in the chaos of in and out. But then you go back and look at the old charts and they tell you the right approach. But that's what works for me, Ravi.
Okay, thank you.
Other questions?
Yeah, thank you for a very informative presentation. Just so I make sure I've got it straight, very simply, how do you determine the high momentum, low momentum ratio? I know that's where we started, but
Yes.
could you just, in 25 words or less? For the slow people here.
Okay. If you have to recreate it at home with Metastock or AmiBroker or whatever tools, first you need a database of stocks. Say the FTSE 100. Okay. You rank on a monthly basis if you want to do it monthly, and if you want to build your database, or you can do it once a week, once a day, up to you. You rank on a 6 or 12-month basis. The studies that I show you are 12 months. So rate of change on a 12-month basis, okay? You rank from the top to the bottom. And then you divide, you take the top 10% and the bottom 10%. And you look at the performance that happens the following month. Because that's the performance of the portfolio of the winners. You do the same for the losers. And you have 2 performances, cumulative. You create 2 portfolios, okay? The ratio between these 2 portfolios is telling you which approach is rewarding or not. So the high-low momentum ratio is just the ratio between 2 equity lines of the high momentum stocks versus the low momentum stocks. You do it on a weekly basis, I think it's best. Daily is very noisy. Monthly is giving you the big picture. I think weekly is just fine. Does it help?
Thank you.
More questions?
Ricardo, may I ask you, in September we went into a situation where if someone's running long short equities, you would be facing the squeeze in the market when all these junk crappy stocks going up.
Yes.
And you're getting killed on sort of metal mining, which was shorted previously, like Roncco as a sort of example.
That's the situation we're in.
Is there any, I mean, how would you preempt that, sort of you figure out, second guess that this is, but the chances are high for this to happen? I mean, subjectively, sort of positioning outflows, etc. But would you apply, for example, RSI on this chart, which may seem counterintuitive, applying trend following methodology? And is there any way to second guess that this momentum is about to start sort of mini crashing, that things are really stretching?
Yeah. Personally, I would use maybe a couple of moving averages, 10, 20 days on the ratio, to try to spot the kind of environment you are, or you can plot the MACD on the ratio, if you really want. And you can see, because you can see that the market, the bull market or the bear market, when it enters trend following mentality, high momentum mentality or low momentum mentality, it stays there for a while, not one day. So even if you miss exactly the first 2-3 days, it's not a big deal. The most important thing is not to be stuck there for 3-4 months or 6 months. For example, you see a situation like this one, when the market started to go down. Look at this, that's the top of the market. Let's say this is the top of the stock market. You see the ratio going down, meaning fear of missing out. Buy the laggards. Oh my God, the market is going to go higher. I want to buy what is left behind. And then the market starts to break down, and you start to see the ratio going higher. This means that the stocks that are the weakest are sold, and you have this acceleration to the downside. Then you have a spike of volatility here, the market bounces, and what you have here is, instead of a correction to the downside, a mean reversion environment. And again, the telltale of a bear market, for what we saw before, is bearish market are trend following business to the downside and mean reversion to the upside. Bull markets, they can be a bit of one or two. You cannot qualify them. But because the psychological nature of a bear market is completely different from a psychological nature of a bull market. Not only the speed, the ability to lose money very quickly impacts the way we decide. Again, for the first slide we saw, in a situation of uncertainty, our brain screws us up. Hence, if we have a model, whatever the model, we have tested when we are cool, calm, and we've done our homework, taking in consideration commission, variables, liquidity issues, and then we follow the model. It's much better.
And this is would you use your forex?
Forex you can use the same. You can have something like the carry. If you have the portfolio, if you monitor the carry trade, for example on Bloomberg, it's because I'm using that at work, you create the basket of a positive carry, and you see how it's performing against the dollar index. In this way you have an indication of, is there a trend following mentality on forex currencies, or there is a mean reversion nature on currencies. So there is the Deutsche Bank F10 carry trade. Is an index like the S&P 500, and it's just the P&L of carries forex. You plot that against the dollar index as a proxy. What you are left with is carry outperforming or underperforming? And if carry is outperforming, it's because you have trend following situations. Does it help?
Have you seen anything in cyclical stocks have been outperforming in the US for quite some time? Have you seen anything to make you think that might come to an end anytime soon?
Well, depends. Cyclicals, you mean industrials? Because if you look, for example, basic materials and energy, they've been completely out of whack, so that would not apply. Industrial stocks have been underperforming.
I mean, there's an ETF, the IYC ETF, which is a cyclical services or something stock.
Yes. But to do that analysis, is a kind of style. It's like buyback stocks. It's like value, small cap against large cap. So the best way to look at those kind of stocks is comparing against the S&P 500. So if you want to own that, you want to check, is the kind of ETF IYC in an uptrend, is this IYC beating the S&P 500? Is in uptrend on its own? If the answer is yes, you want to own it. If not, you leave it. That's the way I do. Every single day, I check all the sectors against the market, and I check the direction. Nothing completely different from other technicians are doing all over the world. That's the best way. The information at this level is to know, do I buy on breakout? Do I buy on dips? Do I sell the rallies, or do I sell the breakdowns? It's a different quality. You qualify in a better way the trend. You cannot do that on a single stock. You can only do it for the aggregate of the stock market. You understand the mentality that is driving investors.
So, in that diagram there, the chart,
Yes.
the white sections, are they the ones where you buy the breakouts?
When the line goes up, is high momentum divided low momentum. This means high momentum stocks, breakouts and breakdowns are working. So here you want to be a trend follower. In the yellow zone you want to be a trend follower. If you are in an uptrend, you just buy bullish breakouts, clear. Okay? If you were in a downtrend and this ratio was going up, you want to sell breakdowns. Okay? And when you in this kind of situation, instead you want to be a mean reversion. So you buy the dips. You look for the RSI oversold. You look for the MACD giving you maybe a positive divergence. All these kind of signals are acceptable in the kind of environment where the ratio, high-low momentum ratio, is actually going down. It's telling you that the portfolio of the losers is actually doing better than the winners.
So why would you go and buy dips then in that scenario? So you're saying that that when the low momentum stocks start to do quite well, then that's relative spread of the momentum starts to
go down. The market goes up, the ratio goes down.
Yeah.
When you have stocks, because this situation lasts for weeks, if not months, when a stock gives you the opportunity to buy the dips, you do it. Rather than wait for the breakout. That is the situation of the ratio going high. You always buy a stock, but the stock is telling you, buy me now when I'm breaking up, or I have a bottom in the stochastic, RSI, and MACD, and then I want to buy it.
Thank you. Thanks.
I get the psychology behind the stock environment, you know, whether you want to have or not have junk type stocks. You mentioned in the currency one though, how does the psychology work in the currency market? Because you did say you can follow the Deutsche Bahn F10 currency price for the dollar index. So what's the psychology behind that?
Well, in that sense, if you have a carry trade, you are funding the buy of a stock of a forex that has a high yield against a low yield. Okay, you're funding yen at 0% and you buy euro 2%. Okay, then you leverage this thing. That index, the Deutsche Bank 10, takes the top 10 currencies and is building a portfolio buy and hold of this kind of carry trade mentality. And that's the logical carry that is done, is a kind of trend following mentality, because you sit down and you wait for the income to come to you. Okay? When that changes against the dollar index, you know that there is something external that is disrupting the carry logic. But it's a proxy. It's a proxy. The best way to do it is to have 30 currencies against the dollar. You take the top 5 and the bottom 5, and then you create 2 portfolios. That would be the best way. But consider maybe it's a bit more complicated and you want to play immediately with the concept. I suggest do a lot of studying on that.
And with that, we'll probably need to bring the meeting to an end.